So 6 months ago, I stole a phrase from famed short seller Jim Chanos in describing Tesla as all sizzle and no steak. 6 months on and the steak has still not made an appearance and the sizzle is starting to fizzle. Not that Musk hasn't pulled out all the stops to keep the hype train that is Tesla chugging along. And so with the latest distractions. Ignore that $600 million loss we took in the third quarter. Look over there at the battery-powered truck. A truck, by the way, that a European consultancy firm said would require the same power as up to 4,000 homes to recharge. Not to mention that the batteries alone are expected to weigh 15,000 pounds and cost $144,500 each at current prices for lithium. Ignore the fact that Tesla forecast they would produce 1,500 Model 3s in the third quarter and only made 260. Look over there at the new Roadster. It goes from 0 to 100 in less than 2 seconds. Ain't that grand? But as the Wall Street Journal wrote back in early October, the truth is catching up with Tesla. So the company said that the reason for the 80% shortfall in production of Model 3s in the third quarter was because of production bottlenecks. It turns out some parts of those 260 Model 3s were being made by hand. Again, from the Wall Street Journal. Automotive experts say it's unusual to be building large parts of a car by hand during production. That's not how mass production vehicles are made, said Dennis Bragg, a manufacturing consultant who's worked in the automotive industry for 40 years. That's horse and carriage type manufacturing. That's not today's automotive world. Now, in my video back in May, I laid out some of Tesla's many production misses, so the latest miss shouldn't be a surprise to anyone. That last forecast of an annual rate of 100,000 deliveries by the end of 2015 took 2 years longer than expected, with approximately 100,000 expected by the end of this year. But that's after Musk claimed in May that they would produce between 100 and 200,000 cars in the second half of 2017 alone. Again, to quote the Wall Street Journal, Tesla has a forecasting problem. But wait, there's more. Mark B. Spiegel of Stanford Capital Management was recently a guest on an episode of Adventures in Finance with Grant Williams and talked about how Tesla continues to backpedal on production forecasts into next year.
He drastically reduced guidance on Model 3 production for 2018. Originally, it was going to be 5,000 a week by the end of this quarter, in other words, by the end of 2017. Now he said they're hoping to do it by the end of Q1 of 18, but he apparently has completely pulled guidance to be producing 10,000 a week by the end of 2018, which they had been saying and reiterating for the longest time. And now they're making up some retroactive bullshit that it was always their plan to not install that second line until this other line was up and running smoothly for a while. So he's backpedaling on that other guidance. Now, in fact, the guys I've read and spoken to who have done a lot of research on this thing tell me that there's no way in the world he'll be building 5,000 of these a week by the end of Q1. And he probably, almost certainly won't be able to build 5,000 a week even by the end of next year.
So the 5,000 a week target for the Model 3 has been pushed from the end of this year to the end of Q1 2018. And the 10,000 a week number by the end of 2018 has been pulled altogether. And if Spiegel's contacts are right and they can't get to 5,000 a week by the end of 2018, that means the company will probably produce less than 200,000 Model 3s next year. So if you're one of the 455,000 lucky customers that put down a deposit on a Model 3, more than half of you are unlikely to receive a car until 2019. Also, remember the solar-powered roofs that were supposed to be put in production last spring? Well, the Wall Street Journal has noted that they are conspicuously absent over a year later. Just another unfulfilled Tesla promise. Now, 6 months ago, I showed the consensus earnings forecast for Tesla and said this. Now, if you go back 18 months ago, there were forecasts that Tesla could earn $20 a share by 2020, and that would make today's price look reasonable. However, the latest figure I could find off NASDAQ was just under $10 a share, and that's been coming down steadily over the past 18 months. Also, Evercore, that was paid $7 million for writing the fairness opinion for the SolarCity acquisition, used forecasts from Goldman Sachs, which at the time had Tesla earning over $1 a share in 2017 and over $4 in 2018. Now, Goldman has since slashed its forecast to a loss of $2.50 in 2017 and a slightly more positive 69 cents in 2018. Now, anytime you see consistent downgrades to earnings forecasts, this is not a good trend. So I'm going to go out on a not so bold limb here and say I'd be surprised if Tesla makes any money by 2020. And 6 months later, I feel even more confident about that statement. Note that forecasts for 2019 have been cut to practically break even, whilst the 2020 number is still wildly optimistic. Now you might say, well, so what? They continue to miss their targets, but they'll get there eventually and profitability will just be pushed out beyond 2020. But the problem is that Tesla still hasn't shown that they can make a profit on the luxury S and X model, let alone on a supposedly mass market, lower cost car like the Model 3. Now, a couple of other interesting segments from the Adventures in Finance podcast I mentioned before was Spiegel's take on the Gigafactory and solid-state batteries being developed by the likes of Toyota.
The next step in electric cars, probably in the early 20s, are solid-state batteries. Toyota has spent a lot of money on these. It's real proprietary stuff. And actually, James Dyson, the vacuum cleaner guy, says he's got some solid-state batteries. At any rate, at that point, you'll have really twice the range and much faster refueling time, and then electric cars will be in the ballgame. Tesla likes to use the word, our partner Panasonic. And when they originally had to set up the Gigafactory, they were allegedly going to have all these other partners contributing money into the Gigafactory, and it would be this vertically integrated thing. As far as I know, the only other company affiliated with it is Panasonic, and it's not a partner. It's a supplier to Tesla. Basically, Panasonic said, we'll put our battery cell making machines in there. We're going to keep the IP ourselves. It's going to be our IP. And, if you give us a purchase commitment for these cells, we'll install the equipment and it'll go on your books, Tesla's books, as a long-term capital lease, which it has. So, basically they're they're proprietary to Panasonic. There's no IP to Tesla on these battery cells. And that's what they're making at 30% of right now of the capacity they said they'd make. And meanwhile, there was just a report in the Korean paper the other day that Tesla is also thinking about buying battery cells, and this hasn't been verified yet, from LG and Samsung. And in fact, Tesla did buy battery cells from Samsung to use on this Australian backup power project. Point being that Tesla has absolutely nothing meaningfully proprietary in batteries, and it may in fact be the high-cost buyer of battery cells in the world right now because of the commitments that it had to give Panasonic in order for Panasonic to install its machines, in that Gigafactory. And it may be that GM and the Europeans are getting better pricing from LG and Samsung and probably eventually the Chinese than Tesla can get from Panasonic. So they may be at a price disadvantage because of that Gigafactory is the short answer. And the other point to make is, as I said at the beginning of this conversation, when solid-state batteries come out, that Gigafactory is completely obsolete other than the fact, that it's four walls and a roof, because it's not set up to make solid-state batteries. So, it's basically could just be a giant useless white elephant in 5 years.
A big white elephant. We shall see. Anyway, the whole podcast is well worth a listen, especially the part about Tesla claiming that their autopilot capability that uses an NVIDIA chip will be upgradable to a fully autonomous self-driving car, which NVIDIA has steadfastly denied, saying that their current chip being used by Tesla can't handle it. Anyway, Mark Spiegel is short the stock, and there is a standing invitation for anyone to go on the Adventures in Finance podcast and put forward the bull case.
Again, as I said at the top of the show, I'd love for one of our audience to come onto the podcast and give us the other side to this argument. So if you're that person, please email me at podcast@realvision.com. And it's not only me, but Mark Spiegel wants to hear from you too.
And if you want to follow Mark Spiegel, he often tweets about Tesla, including this gem today, showing the chief accounting officer exercising and dumping some options that don't expire until 2026. Not exactly a sign of confidence in the future. So Tesla's share price is currently hovering around $308, a drop of about 5% since my last video, after hitting a high of $385 in September. So does Musk have any more rabbits left in his hat to distract the crowd with, or is the crowd finally waking up to reality? Who knows? Anyway, I thought I would end this video with a short segment of famed short seller Jim Chanos giving his views on Tesla back in late September.
You had said in June that you would give up the short once Tesla begins making money, and the predictions on that aren't until what? Later this year at the earliest, but analysts probably thinking second half of 2019.
Not even later this decade.
Okay. So you don't see a turnaround in the works here?
Well, 3 years ago, Scarlett, this company was supposed to be making money now. And now it's supposed to be making money by 2020. And I'm guessing, by 2019, we'll hear about 2025. This company is structurally unprofitable. Its capital structure is way too leveraged. It took on, let's not forget, it took on Solar City for $8 billion in assumed debt and stock issuance. Solar City had negative EBITDA, earnings before interest, taxes, depreciation. So the drain to the shareholders on Solar City alone is about $1 billion a year. That's a big drain.
It's a lot to absorb.
So obviously investors haven't punished the company for the extraordinary losses because they're so into the Musk vision and they're so into the products and they think it's going to change the world, it'll be the next iPhone or whatever. Is there anything that that could change your mind pre-profitability if it started to look like the Model 3 was really ramping up and they were selling and that it looked like they could scale them?
Well, they need to ramp it up. I mean, nobody is buying Tesla stock based on the current business, right? It's all based on the future and the hoped for acceptance of 500,000 to 1 million Model 3s a year, and then plus whatever is coming on before that. But let me make an important point. I mean, one of the reasons this company was successful and that Musk had a really vision ahead of everybody else was that he made electric vehicles sexy, right? The Model S was a sexy car.
You drove the Model S,
yeah,
right?
I've driven one. They're great. It was aspirational. It was not a compromise, right? And whereas most EVs have been a compromise, they're small little bug-like cars, and you feel good about driving one, but they're not really aspirational. They're not cool. And he made it cool. And the problem he now has is, as we've seen in the last 2 weeks with the Mission E rolled out by Porsche which will come out in 2019, is the competition is coming out with sexy sports cars and high-end vehicles. They're putting their existing line, they're electrifying them, or in the case of Porsche, they're actually designing from the ground up an electric vehicle that's a sports car. And this is going to be the reality by 2019. And that's a different animal. You now have lots of competition. You have well-financed, profitable companies competing against you. And one more point. Tesla's now behind in autonomous driving. And that's what a lot of people, again, put these sort of stories like autonomy and mobility onto the stock. They're level 2, same as GM. And GM, many observers believe GM's Cadillac autonomous features are better than Tesla's. Audi's now at 3. And so they're not even the leader in these areas where they were a leader as little as 2 years ago.